Hi, everyone. Thanks for joining in. Welcome back to Wall Street Silver. Joining us today is my good friend, Tavi Costa, partner and portfolio manager at Crestcat Capital. Welcome back, sir.
Hi, Evan. Thanks for having me. Looking forward to this.
Yeah, it's always a huge pleasure you coming down to speak to Wall Street Silver. And everything's going crazy in the economy right now. And the Federal Reserve has just raised rates again, and the economy is seeing lots of distortion. What's concerning you right now in the markets, Tavi?
I think the biggest concern that I think a lot of people are downplaying is the fact that we may see inflation reaccelerating again. And if we go back to stagflationary periods like the 1970s or even the 1940s, what you find is that the reacceleration of inflation is actually coincides with the downward pressure in equity markets. So the decline in equity markets is in line with the increase in consumer prices. We saw that in the 70s and in the 40s, but I would say that why are we in a stagflationary environment today? Well, it's pretty clear if you look at the treasury curve. Majority of the yields that we have in terms of this yield spreads are all inverted. I think 90+% of the treasury curve was inverted not too long ago.
Mm-hmm.
And it begs the question, is this like the 2008 and the tech bust and so forth? And no, not at all. During those periods, the long end of the curve was actually declining as the short end of the curve was actually staying at the same level. Right. Today, we're seeing virtually all yields increasing. And I'll also point out the valuations are a lot worse than they were back in the 70s and the 40s. So this is an stagflationary environment in my view. And if inflation accelerates again to the upside, we should see downward pressure in equity markets overall.
Absolutely. And you wrote recently on LinkedIn on your profile that after nearly 9 months of underperformance, energy stocks are once again starting to outpace the overall market. What do you see happening? Is a commodity bull run coming? What do you see from that?
I think this is just in the middle of a much bigger historical trend that we're seeing. We looked at many times over the CapEx trends for natural resources, and every time we've seen this in history, where producers of natural resources are so unwilling to spend capital, very reluctant to create new projects and increase CapEx overall. Those tend to be periods where commodities do very well, and usually natural resource industries are in very long-term cycles, particularly mining and energy. And so, and that is because it takes a long time for you to increase supply over time. And it also has to do with the intense amount of capital that it requires to do that as well. And the challenging parts of just naturally finding those resources over time, it becomes increasingly more difficult. So I think that in energy space, given how cheap it is, it's part of the rotation from growth to value. And so I think that energy will continue to be a part of the market that should be outperforming all other sectors of the economy. And I expect this to continue. We've had the last 9 months that the trend went the other way. But I do think that the bigger trend means that we're going to see energy continuing to outperform. And that chart in particular just shows you how much this can really run. I mean, this is just the beginning of it.
Yeah, and I have to ask you because we are Wall Street Silver. What are your thoughts and what are your views on silver that you're seeing from now until 2024, the beginning of 2024? A lot of people say that the mining stocks usually move first before the actual spot price of silver. Do you agree with that? And do you see any movement or no? Is it usually tough in August historically?
No, I don't think that that necessarily is the case. I think that a reacceleration of inflation may create some issues short term for gold and silver, which I think we've had those issues already mostly priced in recently. I think we're more on the end of that downward pressure. I continue to think that any person shorting silver with the gold to silver ratio above 80, and knowing that most likely we are entering a secular bull market for gold. I just never seen a secular bull market in gold that silver didn't lead. And so, to me, it's just it's betting against history, and I would never do that. And the more important side of it is how cheap most of the miners continue to be. Particularly the ones. It's actually very interesting because if you do research on the high quality assets versus the more poor assets in terms of quality, you're going to find that they're all priced in the same level. So, for anybody really willing to do the homework and the diligence in this part of in this whole industry of the mining space, I think there's a lot of great opportunities for the long term to pick and choose companies that are high quality assets that could potentially do very well in a secular bull market for gold, and where silver should also lead the way. And just one final point is commodities are all interconnected. So if you get a bull market in gold, you will get something even in agricultural commodities. All those charts look the same way. So I would suspect that if we are really in a place where energy and other parts of natural resource industries would do very well, I would say silver and gold and all others should do well as well.
Absolutely. And the news came out, Tavi, not too long ago about, and it's been after months of debate about various currencies and commodity baskets. China and Russia has settled on gold as a basis of a new international-led system. Do you believe that their BRICS nation, now that they came out and said it'll be gold that will be backed, do you believe it will work, or will it take a long time? What's your views and thoughts there?
Well, I think we're entering a world where central banks are being forced to improve the quality of their international reserves, and that just means almost exchanging what they own of treasuries for gold. And so we're seeing this accumulation process of central banks in a significant way, particularly coming from emerging markets. And I think that will continue over time, especially at a time when interest rates are higher, which requires more volatility on the FX market. And that will continue to question monetary systems that are weak because of the quality of their reserves, because that ultimately is what creates the credibility for any currency, is what they hold in terms of their reserves. And so to me, it's more of the question of the BRICS and so forth. It's important to break down that the BRICS, the economies that are part of those of that block, are very different economies. You've got an authoritarian regime that is a net importer of commodities like China. You've got a commodity exporter like Russia, but it's a geopolitical mess as well. Then you have India, which is less of a geopolitical mess, but it's also a commodity importer. And then you have places like Brazil, which to me, it's even more interesting, that are commodity exporters in a little less than a geopolitical mess. They're a very neutral country and so forth. And so to me, there are major differences in terms of investing in emerging markets. And I can see a multipolar world where gold can become more of a settlement way of creating those transactions over time as well. And that ultimately is negative for the dollar, sure. And but the dollar is also seen as you have to look at that relative to another currency. I think the bigger issue is what we're seeing in terms of the twin deficits across most developed economies, meaning very large fiscal stimulus, along with the fact that a lot of those economies have trade accounts that are negative too. So that's creating further pressure in those monetary systems over time, and why I think that it's time to be bullish on resource-rich economies, and Brazil would be a great example of that.
Absolutely. People are really concerned about the debt servicing on the US debt of 32 trillion. They're saying soon it'll be northwards of 1 or 2 trillion just on interest on that 32 trillion. So where do you see the collision and the breaking point? As you just said, the physical stimulus just going to around the world just keeps growing and increasing. When is that breaking point where you see it affect commodities like silver and gold? And how long can they keep this whole game going?
Well, there's two things going on. They're unsustainable. Monetary policy is tightening significantly, which has been causing the cost of debt to increase. And the other thing that's happening is the fact that the government is spending more and more. And so the debt is increasing and compounding at a very alarming pace. So which one is going to give? Will the government reduce their spending, or will the Fed reverse their policy at some point and be the buyer of last resort of those treasuries? Now, I happen to believe that we're going to see the latter, meaning we're going to see the Fed sort of reestablishing their role as a fundamental financier of the U.S. debt. And in the fact that we're not seeing foreign institutions being buyers, U.S. banks are not being buyers, even individuals are not buying treasuries to a degree that we saw even during the 40s. when we had the war bonds and other things that individuals were helping to finance the government. So today it's a very interesting setup because you have the green revolution, you have the need for reducing this reliability in other economies like China. So countries are having to kind of rebuild their infrastructure and manufacturing plants. You have very large social programs, given the fact that we have such a large amount of inequality in wealth gap in general. And so all those things are playing a role. And also you can add on top of that the fact that we've had a chronic period of underinvestments in natural resources, which at some point is going to require a lot of infrastructure development, and even housing is going to need some construction too. So all that leads to tangible assets doing very well, in my opinion. So that's the whole reason I think that, or one of the primary reasons why I believe that tangible assets, meaning commodities, will outperform financial assets, particularly at a time when you look at commodities to equity ratio, basically we are at a 50-year low today. It's starting to rise. So to me, that's the key here.
Absolutely, well said. And just a question a little bit more on like the silver gold side. What does Crestcat Capital look at when they actually look at, let's say, before they even start investing or looking at a silver or gold mining company? What does Crestcat Capital do, and what do they look at before they even dip their foot in?
Well, Crestcat is looking to replicate what most of the billionaires in the industry have done, which essentially is investing in exploration stocks. Majority of the exploration successes that we've had in this part of the industry really was what created majority of the billionaires in the industry as well. So for us, yeah, I mean, you know, from all sorts of names. And what is interesting about this is, in my view, is that a lot of people are not focusing on exploration side. And so there's a lot of, in my view, a lot of valuation discrepancies that helps investors like us to really dip our toes and look for ways to create value on those businesses. And so, like I said initially, a lot of those companies are priced for failure right now. So you can create essentially a hybrid venture capital approach, the same way most of the folks in Silicon Valley have done so well investing in technology businesses. But the difference here is that if you do that in the mining space, your odds are much better because of the fact that the valuations are so low. And so to me, it's one way where we can own, 15-20% of a business, where we can even help them to design their drilling programs and even increase their odds of success. So it's in one way, we're just trying to add value, but not only being an owner of those businesses, but also helping them to succeed over time. So that's basically what Crestcat is attempting to do here.
Yeah, very interesting. Well, Tavi, it's always a huge pleasure you coming down to Wall Street Silver, and especially talking to everyone about what's going on in the markets. And hopefully as the markets develop, we would absolutely love to have you back. And we'll see what Powell does next, because it'll be interesting. What do you think? He'll pause or keep raising rates? What do you think?
I think if inflation reaccelerates, we'll continue to see rates, actually the Fed perhaps even having to hike rates a little bit more. Although eventually, I do think what I said initially in this conversation, that something has to give, and that is going to be monetary policy. But first, I think we need to see some further pressure in the economy that forces the Fed to then, change their course. And right now, if inflation reaccelerates, and when I look at things like the euro dollar curve, which are now pricing in the largest rate cut in the history of the contract, I'm obviously like to be a contrarian when I see those things. And so I don't think we're going to see rate cuts as soon as the market thinks. I think it's going to take a little more time, and potentially we're going to even see further hikes. And so I'm in that camp right now.
Yeah, it's going to be very interesting to watch. Well, thank you again, everyone, for watching. And thank you, Tavi, for coming down to Wall Street Silver. And yeah, I'd love to have you back.
My pleasure. Thanks for having me.